Hello, this is Mike Swanson. I run the website wallstreetjournal.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, this week, we're approaching the end of January very quickly. This year is going by, but we're going to see a Federal Reserve meeting on Wednesday. Now, everyone kind of knows already what the Federal Reserve is going to do. They're going to raise rates by a quarter of an interest rate point, and then they're going to set the stage for probably one more rate hike in the next meeting, which will be in March. And we're approaching the end of this interest rate hiking cycle. And the end point was visible a couple months ago, really since the end of October. And ever since then, we've seen strong rallies in markets all over the world, in big moves up in gold, in mining stocks, and the U.S. stock market followed suit and also has rallied. Now, those other markets went up faster than the U.S. stock market, and for most point are up at a bigger percentage from where they were in October and even Labor Day than the S&P 500 and the NASDAQ are. But think about where we were just 2 years ago, 2 weeks ago, not 2 years ago. Well, we'll talk about, let's look at 2 years ago first. When it comes to the internals of the stock market, in 2021, they were in decline. This is a chart that you're now looking at of the percentage of stocks on the New York Stock Exchange trading above their 200-day moving average. And as you can see, that was going down while the S&P 500 was going up. And this made me become bearish on the stock market. And I took action myself, went to 50% cash in June, July of 2021. And I didn't care that the S&P 500 would likely go up a little bit more, and it did. It didn't bother me one bit because this was an indicator that had always reliably signaled in the past that there was a bear market coming in probably months, possibly weeks, or at the very least, a substantial market correction. Of course, we got the bear market. But just as this indicator made me bearish in 2021, it formed a positive divergence this October. It turned up in that month as the S&P continued a little lower. I took note of this after New Year's this year to note, look, this rally is different than the ones in the past. It's not simply a bear market rally because we're getting internal confirmation of it, and things have stacked up very well since then. But if you think back to 2 weeks ago, people were looking at the downtrend line on the S&P 500 that you can see on this chart. It touched it, came back hard 2 weeks ago. I think the Dow had a day where it was down over 600 points. The daily stochastics, and it's one of many technical indicators, gave a sell signal by crossing above 80, then back below it. That's how it gives an overbought sell signal. But the market did not collapse. It did not sell off as people were warning it would. And that's a sign that the bear trend of last year is not in place this year. We're in a different market environment than we were in 2022. However, we're also in a different market environment than we were before 2022. So we're not going to go straight up, like we did in 2018, after the market fell 20%. We're not going straight up like we did in 2020. One reason why is because the Federal Reserve is not going to just cut interest rates like they did in the past, real rapidly back down to zero. The reality is the inflation problem still remains. Inflation, the pace of CPI inflation growth has only come off its highs. It has not gone back down to 2. And we don't really know if it will go back down to 2. But we do know is that the Federal Reserve is reaching the end of its interest rate hiking cycle. It is said repeatedly, spokesmen for it, including Chairman Powell, have said that they want to pause before they make any more moves in interest rate hikes after an additional one or two. So that's where we're at. And the reason why they want to pause is because they want to make sure inflation really does go back down to 2 as they are predicting. But they also do not want to raise rates too much and cause the economy to go into a deep recession in which they would be forced to lower interest rates. So that's where we're at. And that's still, for the standpoint of the financial markets, a more easy money market than we've seen in the past, enough to bring more money flowing into the financial global economic system, but not as much as you saw in 2020 or 2018 or 2016 or after 2009 when they launched all these QE programs and did all sorts of stuff. No, that's not where we're at. But we're not in a bear market like last year either. So what is happening is money is coming into the financial markets. And it's not just the US stock market. This is a global financial market system. And that's why this year, the price of gold has done better than the S&P 500. When you look at the relative strength plot, I mean, you just see gold went from 1625 up to 1950, smashed through the 200-day moving average in December, where the S&P 500 just closed above it last week. And now it's near its April high. The relative strength ratio comparing gold to the S&P 500 has been trending up over 12 months. And, it's bumping up on its June high too. If we look at the emerging markets ETF, which measures, emerging markets outside the United States, it's been outperforming the U.S. stock market since November. Also went above the 200-day moving average in December. But there are pockets of strength inside the U.S. stock market, sectors that are outperforming the averages and outperforming the stocks that so many still are enamored with, such as Tesla, such as Netflix, such as Google, such as Apple, such as Microsoft. Microsoft at earnings last week got smashed on that. But there are a few tech stocks still, outperforming. One is NVIDIA. I own a position in NVIDIA, just pointing that one out to you. Another one is eBay. And you can see the relative strength index going up. So, to me, the best stocks are in the best sectors, and the best things to invest in are things outperforming the S&P 500. If something is lagging the performance of S&P 500, then you have something that is in a position where when the market does have a dip or a correction, to get completely smashed. Laggards tend to fall really bad on mere market pullbacks. And then when you have the rally, they don't go up as much as the market does. So you end up kind of, in a bad spot. It's not what we want to be in. So really last week, I'd say nothing has really changed for me, at least the way I view things from the way I was, since New Year's. And don't really think any big surprises are really in store this week either. So I just want to give you an update on what I think is going on, and I'll be talking with you later. Oh, like this video so that I'll know you like it. And if you're new to my stuff on YouTube, hit the subscribe button, hit the bell next to it, and YouTube will send you an alert as soon as the next video is up. And I'll be talking with you.